bonds and challenges, total impact bonds.
Well, I'm assuming they're referring to our notes.
I think so. Yes, notes, bonds, somewhat the same instrument, if I remember. And then challenges / barriers to reaching that 10x.
That's a great question. So first and foremost, I think the point Charles made before is something we should all be striving for, which is finding ways to create aggregation, which is really critical to getting to the scale that we're trying to do. And from my perspective, if the whole point of the total impact notes is to create an aggregated pool that opens the aperture of participants to a much broader group than what we have today. So for folks who want to invest in high impact opportunities in emerging markets, there are not a lot of great options unless you're an IDB or a DFC or a family office that has a strong footprint overseas and can actually look at all the different opportunities and really analyze them at a fairly granular level. And that means that a large swath of folks who really believe in making a difference in the emerging markets are on the sidelines. And so I think part of what we should be doing with blended capital is thinking about how we bring those people off the sidelines. And by that, I mean the donor advised fund world, the clients of values-aligned wealth managers, the values-aligned institutional investors who have put set-asides for higher impact investments. And all that, there's a lot of capital out there that I think is very interested in a high impact, modest risk, and not necessarily high return opportunity. And part of what we need to do is figure out ways to bring together all those opportunities that exist, because they do exist, into digestible products that those people can put their money into.
Thank you. I think we're almost at time, so I might just kind of provide a question and throw it out there, and feel free to answer however you want. We're talking about scale once again, and the textbook definition of scale is to do more with the same amount of resources you have, ultimately, not continuing to make an investment, but the output is greater with the continued investment, in this case probably time and energy related to blended finance. Are we achieving scale? What keeps you committed to blended finance? Especially if a new deal just reaches your desk. Do you look at it exhausted, or do you say, yes, I'm ready to take this on and continue proving out the model? And Charles, I will start with you as the most difficult question.
Yeah, I think it's important to often look beyond the specific deal. I think when we reflect on our 40 years plus of making impact investments, one of the interesting observations is that one transaction often leads to another, and long-term results at an organizational level or an institutional level can be very different than what you expected. And maybe I'll use a couple examples. So I keep leaning on the Catalytic Capital Consortium investments, but one of our non-blended investments, which was led by a group called Social Finance out of Boston, created something called the Up Fund, which is an innovative model for financing workforce education using income share agreements. And it was an unblended $50 million fund. And that was, the fund is deep into its life, and there's been some challenges with that Social Finance has reflected on that on their website. And they've talked about some of the regulatory challenges around using income share agreements. But one of the things they were able to do subsequent to that is create a workforce education financing program that was funded by Google at $100 million. So twice as big as the original fund. And that one's blended. So we invested in a single class equity fund that then led to a blended fund based on the learnings from the first fund. So I think if you take the long view and are investing in a way that has high additionality, has the potential for learning, has the potential for something to occur subsequently, and not just focus on what does this transaction do in isolation. I'll just use that one example, but there's lots of examples where one investment has led to something subsequently that goes beyond what the initial view of the investment was.
Yeah, that's great. And I think we are almost at time. We'll add some additions here. I just want to quickly, what you're saying brings me back to the old SOCAP at the Wharf, where it was a small room and typically a shouting match between impact investors and opportunities or deals. And the impact investors were basically saying, we want to participate in your deal, but we do not know how. Can you please tell us? Can you provide something like a term sheet? And on the other side, it was, well, what is a term sheet? And I raise that only because blended finance in some way is creating that scaffolding and structure for more impact catalytic capital to participate in deals that they couldn't years ago. And so if anything, we're blending certainly for risk-adjusted returns, but also blending so that these tranches now are made available to the capital sources that wanted them in the first place a decade and a half later. Thank you for that reminder. Just any reactions on scale? A deal hits your desk at IDB and you're like, oh, not another blended transaction, or do you say, yes, I'm ready?
We analyze hundreds of opportunities each year to pick 5 for our tickets. For example, for our instrument for investing in impact funds, we analyze between 100, 120 applications a year, and from there we decide very carefully which will be our 5, 6, 7 tickets annually. And I would say we are reaching scale because at this point, we've been doing this for the past 30 years. Right now we have around 55 active funds, but from these 55 impact funds, we are supporting more than 900 startups in the region. So that's one of the ways that we're reaching scale very, very, very clear. Is one of our ways of working with our instruments to reach scale.
Great point. Just that overarching higher capital raise opportunity that we sometimes forget about. John, parting thoughts, ending thoughts?
Yeah, so first I'd like to bring us back to the point you made, Leah, about why do we do this to begin with. And I think we talked a little bit about the need to address misperceptions and risk. But I think there are 2 other reasons that are important. There's certain services to be delivered to people that are very tough to do without support services like technical assistance or sort of management subsidies or things of that nature. And so we also need to blend to take care. So we've talked about guarantees, we've talked about first loss, but there's also those other types of blending, which I think are fundamental. And then the other reason why we do this is because the point that I made before, which is there's a lot that's worth doing that isn't going to reach the return level that a fiduciary is going to look for, and yet we want to be able to mobilize that fiduciary capital. And so we need to, at some level, provide an implicit subsidy to make that happen, and hopefully over time, the gap between that implicit subsidy will go down. But the last point I want to make is this one you were saying about on scale. I think one of the big challenges with blended finance is a bit what Charles was saying, is how each project is a bit bespoke. But the thing that nothing starts at $1 billion. Everything starts with the first step. And I think what we have to recognize is we need to do these early deals, these somewhat more difficult deals that are relatively small scale to get to the point to have the learnings, to be able to get to the much larger scale deals that hopefully will crowd in the very large pools of capital that we need to achieve the goals that we've set out, the sustainable development goals and things like that, where there is this, $2 trillion gap, I think, in 4 trillion is what it is. So the parting thought is, if we're going to get there, and of course some people argue we aren't, but if we're going to even get close, I think blended finance is a fundamental way of doing that. And that's a big part of why we need to blend better.
Excellent. Okay, good. Well, hopefully this conversation on innovative finance has been a conversation on inspirational finance for everyone. With that, I think we're ending. And if I'm not mistaken, or do we have more time? Oh, we do. Okay.
Oh, I should have.
Who wants to
pulled
talk
off
about
on my,
finance more? Any additional questions from the audience? If not, I will raise what seems to be kind of a controversial I'm not sure. I'm going to ask the panelists to decode it. Okay. Do you see any relationship between the level of blending and actual losses? Meaning, I think what the question is reading, and feel free to stand up if it's your question. I think it's saying, do investors take more risk because they feel maybe a false sense of comfort in a blended solution, or is it just vibes? That was, so it's very California, I feel like. Vibes, it says vibes. So meaning a false sense of protection. And if we could drill down on specific examples, because maybe, Carolina, starting with you, I think you raised a very valid point, which we overlook, is your portfolio blended finance structures are actually supporting, was it 600, 900 entrepreneurs? So kind of, have you seen cases where you've maybe taken more risks than you wanted or anticipated? In fact, as an example, John raised with Convergence, where we might have had a false sense of security.
Yes, it's a good question, and it's very hard to answer at the very end of the conversation. I think that the issue is that we see blended finance as a subsidy, as a way of filling a gap, and not from a more holistic perspective. I think that when we change that, we start like having like the same results as you will get into other kind of like financial structures, and I think that's key. When you actually, at the beginning of the conversation, when you're structuring, you're already thinking that you're going to lose, and the first loss ticket is definitely going to be lost, then you're probably going to lose the first ticket. I mean, that's very clear. When you are giving a convertible grant, thinking that you're going to lose the grant and it's not going to be convertible to anything, for sure it's going to be to keep in a grant. But if you actually, when you're originating and when you're designing the vehicle, you're thinking not only about the impact and about the development side of it, but actually also in the rest of the layers that you should be thinking in, from the financial perspective, from the market perspective, from the paths for scaling up, the exit strategies, and all of these other variables, you will end up with structures that actually can have a performance pretty similar to the others. But I would say that at this point, it is common to see more like not that good results as in non-blended finance structures.
I have a question just to add to that, and then John, please respond to all of this. Recapitalization in blended structures. Do blended structures get to a point where an equity investor is seeking some level of recapitalization? Because that's that would be a natural tendency for that asset class after that 5 to 7 year point. So maybe think about that a little bit, how once the blended finance structure is launched, how do you actually provide, quote unquote, investor IR, investor relations, that can support each of those asset classes within that structured solution? I don't even know if we've gotten there necessarily in the ecosystem to understand those nuanced reactions of investors within the structures, because they do want quite a bit of hand-holding at the beginning, and then certainly quite a bit of attention along the way. But John, reaction?
Yeah, I mean, so I do think this idea of recapitalizing structures to reduce the level of concessionality in the structure over time is absolutely what, again, should be the goal. I mean, I think about the medical credit fund, which had, in essence, 2-to-1 leverage on its grant capital to start, and then after about 5 years was refinanced for a 6-to-1. And that meant that we got a lot more leverage. We went from 15 million to 50 million, a lot more impact. And now, there's been, more than 200 million that's been dispersed in loans to health facilities in Africa. So I absolutely think that should be our thinking, is whatever the blend is that you start with, what are the ways to especially if you're talking about risk mitigation as opposed to the technical assistance or the management subsidies. You should be thinking about, over time, we want to drive this down and drive up the level, drive down the level of concessionality, drive up the level of and I don't want to say market rate because I still think a lot of these structures will not produce market rate returns, but drive up the level of non-concessional capital into the mix. I think people call it restorative capital, something, a name that people use for the capital that's not looking for market rate, but is looking for regular return. And another point Carolina made, which I think is fundamentally important, if you think you're going to lose the money, you probably will. You shouldn't go into a structure with the idea that this is probably going to lead to a loss. Probably one of the most successful structures I was involved in that regard, which a lot of people probably thought we were going to lose money, is something called the Iraq Middle Market Debt Facility, which was a loan facility that was created in the midst of the Iraq War to support economic development in that country. And a lot of people thought this isn't going to work. But now it's the largest part of Vitas's portfolio, and has produced a pretty steady stream of profits. And it's because the folks who implemented that, a group that was at the time was called Global Communities, and then they spun it off into Vitas, really took seriously the idea that even in the midst of a war zone, we're going to make loans that stand up to rigorous underwriting, that yes, have a lot of impact, but also are likely to be paid back. And they've had a portfolio that survived unbelievable hits, including obviously the takeover of ISIS of half the country and everything else, and yet they've kept going because of that underlying rigor that they built into the system.
Exactly. Which goes back to that mitigating that false sense of security with blended finance too. Any burning questions from the audience, comments, reactions, how to? Okay. If not, then I will close it with you, Charles. Yes.
I thought the pressure was supposed to be on you, Leah, not me.
No, I shifted it over to you. Okay. So with that, question is MacArthur strategy. I mean, you are a bright light in this whole blended finance space.
Maybe we'll just leave it at that then?
Yes, we will.
All right.
Yes, we could leave it at that. But I think it's worth the audience understanding, because we look at this transaction by transaction basis so much, but is there strategy as an organization considers blended finance? I believe IDB has, so I won't even go there. But with the philanthropic side, are you leaning into this model more so or not?
We're leaning into catalytic capital. That's the way I would say it, is that we view it as a scarce, important resource that has tremendous potential in blended structures, but not in blended structures as well. So our strategy is to look at, when we consider investment, you were using the example, what do you do when something comes across your desk? So there's 2 or 3 levels we look at. One is, does it align with a particular open, active strategy we have? So I've talked about the C3 portfolio. That's not, so we built the portfolio, we're not actively deploying capital to it. So are we actively deploying capital to it? The second thing is, how does our capital, how much additionality is there in terms of, is there some innovation, is there replication, is there mobilization? We're looking at the role that the capital plays, not just the end impact. And so if a blended structure meets those requirements, there's a strategy alignment, and then there's a capital impact, we'll absolutely do it. But in all cases, the bigger question is, what are we doing with our catalytic capital? How does it advance our strategies, and how do we use it most effectively?
Thank you, and recognizing blended finance as a tool to do so. So with that, I think all of you really, I mean, it's been an impressive group, just highly attentive to this sometimes esoteric topic. So thank you, and your interest in blended finance means a lot. Please feel free to pull any of us aside. We're happy to chat more so about your individual experience, but thank you for your time today.